And our year review of this year's biggest stories continues tonight. In business, a reality check for the once burgeoning tech space. And the sector is no longer booming, and tens of thousands of jobs have been axed. The market cap of tech firms has also plummeted. How long will the pain last, and will there be any survivors from 2022's bloodbath? We'll delve deeper in a moment. But first, here's the state of play in 60 seconds.
For some, this year's tech meltdown marks an end of an era. None of the 15 most valuable US tech giants has generated positive returns. Microsoft has shed about $700 billion in market cap. Meta shares have contracted by more than 70% from their highs. In total, investors have lost more than $7 trillion. A slew of factors in play. Soaring inflation reduced the profit for companies. It also forced consumers to tighten their purse strings. Successive interest rate hikes choked off access to easy capital. And in addition, the war in Ukraine and souring geopolitical tensions between China and the West added to the uncertainty. As a result, many tech giants shed workers or shut down experimental projects to cut costs. But looking ahead, it's not all doom and gloom. Analysts say the US Chips and Science Act and China's reopening may lead to new opportunities.
Well, Independent Solutions Wealth Management Portfolio Manager Paul Meeks joins us now. Paul, tech has been a market leader for years, so some expected a correction, but this descended into a meltdown. Did the scale and speed of the sell-off come as a shock?
Well, it's always a shock when you're living through it in real time, but when you think about it and step back, you probably shouldn't be so surprised, because technology spending, whether it be in the enterprise or for consumer customers, is related somewhat to the economy, right? There is a cyclical push, and technology exaggerates the good times and unfortunately exaggerates the bad times too, of which we're living in. And so we'll get through this patch. I think actually it'll be troublesome for tech probably through at least the next summer. And once we get to that point, we might get some relief.
As you pointed out, it's got so closely related to the economy. And so the causes of this tech meltdown have been widely mentioned: recession, inflation rates. But, how big a factor were those strategy shifts at some companies? Meta, for example, its pivot to augmented reality in the metaverse.
Yeah, you're absolutely right. One of the parts of the tech sector that has been so badly bruised is social media, Meta, the former Facebook included. And of course, they've been hit by some of these macroeconomic variables that they could not avoid. But one of the things that happened that folks should really realize is about a year ago, Apple allowed folks on their phones that were downloading apps to opt in or opt out of being tracked for advertisements. And that was a change in Apple's privacy policy that really damaged Meta, because now with an opt-out for a phone customer, then you don't have the same kind of digital advertising pull from the advertisers through Meta to those customers. And so Apple's privacy change in their iOS on their iPhone really damaged, particularly the social media companies and specifically Meta.
Well, Paul, when we talk tech, we also cannot ignore semiconductors. Some of the chip makers, they had a roaring year last year, only to join tech in the meltdown. What is your take on chip makers?
Yeah, chip makers are absolutely critical because of all the industries that comprise the tech sector. This is the biggest by far. And unfortunately, last night we had another very negative data point. Micron Technology, ticker MU, one of the leaders in the planet Earth in memory chips with Samsung in South Korea, really had shocking news. They're going to fire 10% of their employees, about 5,000 people. It just adds to the bedbath of all these employees being fired in the United States. So far this year, we're up to about 200,000 or 300,000 folks, unfortunately. And so Here's the rub. If you're going to play semiconductors, and I do from time to time, what you want to be in are the companies that supply automobiles and they supply other industrial applications. The chip makers that supply consumer electronics, specifically personal computers and smartphones, will probably continue to be in trouble for some time. So there's a bifurcation there. Auto industrial, okay. Anything consumer electronics, avoid.
Well, Paul, you did mention that we're going to be seeing some tough times right till next summer. But then what are some signs that we could be looking at that a recovery could be underway, some green shoots? And when do you expect that we could start to see them emerge?
Yeah, so when we invest, we are investing not for fundamentals today, but fundamentals 6 to 9 months out. So I do believe that when companies announce their December quarter results, which will begin in about the third week of next month, they will have some very nasty news. They will have Micron last night type news, and they'll announce that 2013 will be troubled. They'll probably announce some substantial layoffs, unfortunately for those people. However, if they cleanse the palate, so to speak, and they get the estimates on Wall Street for revenues and earnings per share down far enough, and so those numbers revised fully reflect a U.S. recession, then at that point, I think it might be time to turn around and buy them. The stocks will be cheap. The estimates will be as low as they're going to go. And since we are going to invest for not early 2023, but late 2023 into 2024, I think the recession in the United States will be rather short and rather shallow versus previous downturns. Then we will get a go-ahead sign. But I at least want to get through these quarterly reports, which will be coming to us fast and furious late next month.
Well, and Paul, also want to ask you, zooming out, how does this shake up both for the tech industry overall? I mean, is it necessarily a bad thing, or do you think this is a good opportunity to weed out, say, the weaker, smaller competing players?
Yeah, it always is a cleansing process. We saw this in previous downturns, particularly after the internet bubble popped in the very early 2000s. You will have some companies that will come out stronger. And when they come out on the other side, some are established companies today, some are newbies. They might be the leaders, not just in tech, but in the U.S. economy going forward. But then you'll have a lot of companies that probably should never have come public. They don't have a pathway to generate cash flow or earnings. And of course, they will go away. And that may not necessarily be a bad thing in the long run.
And, one final question before we go. What is your outlook for the tech sector next year? Some challenges, some bright spots. What do you see on the horizon?
Yeah, so what I see on the horizon is we'll continue to be troubled. Remember, I think that these December quarterly reports in which companies unveil their plans for the next year will be very nasty. We'll have a chance to lower those estimates to the floor. And once the estimates are lowered to the floor, we can beat them going forward. So my bottom line is brace for the storm. Be very wary. Do not pile into technology stocks now. Let's go through the confessional period, which is those quarterly reports next month. And then let's recalibrate. I think actually we'll have a good performance, not just in some tech stocks, but overall in the U.S. equities as we get to the second half of 2023. And so I actually think stocks in the States will be up next year, but they'll start the year on January 1st in a dark spot, but finish the year strong. So stay away for now. Get ready to buy. And when you buy, you may want to buy aggressively.
Oh, thank you for joining us. Independent Solutions Wealth Management Portfolio Manager, Paul Meeks.